Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us at the MarketSite studio, we have Joyce, managing director on Nasdaq's Market Intelligence Desk, for an update on technical levels to watch in the Nasdaq 100. Brian, and I think really a big part of the story for the first month of January is the rally that we've seen in the Nasdaq 100. The question is, how sustainable is this? We have the Fed next week. We have jobs number next week. We have a slew of Nasdaq 100 earnings next week.
Yeah, I mean, a lot going on. We had Microsoft earnings come out today. I don't think it was considered to be a great earnings call, to say the least, but stock is actually up 2%. So as you noted, the market is off to a very strong start. Nasdaq 100 is outperforming, up 10% month to date. We did underperform last year, and I think kind of that's what's going on. You're seeing some of these stocks that have really sold off hard in 2022 are seeing a rebound right now. I suspect investors came into this year more cautious than normal, given what happened in 2022. A lot of analysts were calling for a recession, many of them in the first or second quarter of this year. And now we're seeing so far in 2023, more analysts becoming more optimistic, hearing more of our soft landing or no landing at all kind of calls coming out. So the job data has been good. Today's durable good numbers was very positive. So we're seeing some mixed economic data coming out. The leading indicators, housing and PMIs have been not good, but employment has still been holding on very well.
Yeah, and Microsoft earnings came out Tuesday night. Just in case anyone's catching this on the replay, we don't want to confuse anyone. Let's take a look at your first chart here with the Nasdaq 100. And I also want to take a look at the SOX index, of course, the semiconductor index, because that's really where a lot of the strength has been coming from.
Yeah, absolutely. So the Nasdaq 100, you can see we're kind of in this sideways range right now. What was a minor pivot back in September, brief support the same month, and then all throughout November and early December, we saw that resistance level. That's around 12,000. It now coincides with that 200-day moving average. So from a technical standpoint, there's a little bit of a cluster of technical resistance right there. We know the 200-day is very popular, and just because it's a common or popular moving average, it doesn't always come into play for all securities. In this case, we can see there is some recent significance between the Nasdaq 100 and the 200-day. Was resistance back in April and then also back in February on those temporary rebounds during the 2022 decline. So I think it's an important moving average right now and coinciding with these recent highs. So 12,000 is a key level. The width of that range is about 1,300 points. So if we can break out above that, the expectation is a move up about 1,300 points to about 13,300. So that would be up about 10% from around here. If we can see that upside breakout, that would be the expectation.
Right. And how about the SOX index? Because really, I mean, it's had quite a run since the beginning of the year.
Yeah, and so you could see this week the SOX index is breaking out from some highs that have been in place since mid-November. As you noted, it's up a lot from the lows. We can see it's up about 42% from the lows. So that looks, very good from here. And if the SOX is leading, which I think you highlighted that last week on our call or 2 weeks ago when we last did this, but that would be a good indication that say the broader index maybe of tech and maybe the broader Nasdaq 100 will move higher. The three biggest weightings in the index: tech, discretionary, communications, top three performing sectors this year so far.
And I think this was so interesting because it's not like it's one or a cluster of stocks that have the heaviest weighting in the index that are moving. It really is broad-based. You're getting participation from, not just the Microsoft, Apples, Amazons in the world, but all the different components that largely make up the Nasdaq 100.
Yeah, absolutely. If you look at the equal weight index, it's been outperforming the cap weighted index, since late December 21. So last year when we had this big downdraft, it was the larger cap stocks that actually underperformed. So you could look at that a couple of different ways, but if you look at it from the perspective of what's the breadth of the index doing, the breadth actually looks better than, say, what the actual index does, when breadth can often be a leading indicator. And if we want to look outside the Nasdaq 100, we're seeing a lot of optimistic price action in other groups. We've seen industrials looking well, a lot of those mining stocks are looking well, emerging markets is looking well, and the dollar, to switch asset classes, is trading around 52-week lows. So we know there's been a considerable decline off the highs from last summer, and we haven't been seeing a rally higher in the dollar, despite some economic data that looks to be better than I think what many people expected.
Right, but a lower dollar is going to be good for multiple asset classes, of course, right? Good for
Absolutely.
Commodities, good for your multinational conglomerates, obviously good for emerging markets and so forth. So to your point, it feels more broad-based, and as a technician, you're looking for that breadth as an indicator for some sort of direction.
Yeah, absolutely. And, we have a Fed meeting next week, so, we can see, what Powell comes out and says. he's looking to tighten financial conditions. So everything that's now underway is doing the opposite. When the markets rally, when equities rally, when rates come lower, fall down, that's loosening financial conditions. So it'll be interesting to see if Powell looks to get out ahead of that. Maybe the Fed, I would suspect, wants to not see the market, rise too fast in a short period of time. So maybe what they'll try and do is try to be more hawkish than maybe what the market's expecting. Terminal rate right now is pricing around 4.9%. That peaked all the way back in November at around 5.15. And then the bond market is still expecting rates to fall towards the end of the summer, whereas the Fed is adamant that they're going to keep it elevated throughout all of 23. So
it's like, all right, either 25 basis points, 50 basis points. Are we tightening? Are we staying the same? Are we going to, loosen policy a bit? It's really one of those 5 scenarios. That's good, at least for the initial reaction in the market.
Yeah, I think the market's now pricing pretty strongly 25 bips. So, I'll go with what the market is expecting. And if Powell's looking to, rein in this relief rally, or at least try and tame it a little bit, keep it under control, so it doesn't lead to future inflation, I suspect that he'll be talking, hawkish.
All right, fireworks next week, that's for sure. Thank you, Brian. And thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.